Britain's economic performance since the start of COVID-19 pandemic has been stronger than previously thought, with faster growth than Germany and France. According to the Office of the National Statistics earlier today, Britain's economy in the second quarter of 2023 was 1.8% larger than in the final quarter of 2019, the last full quarter before the start of COVID-19 pandemic. An increased estimate of the size of Britain's economy had been widely expected after the Office of the National Statistics published preliminary revisions on September 1st, suggesting the economy was already 0.6% larger than its pre-pandemic size in the final quarter of 2021. Recent growth has been lackluster by historic standards, and many households have been severely affected by the soaring cost of living and which accelerated after Russia's invasion of Ukraine in February 2022. Asian shares had their best days in weeks today, but we're still on track for their worst quarterly performance in a year as worries over elevated interest rates dragged on sentiment. While the dollar wobbled, oil price held their ground. MSCI's broadest index of Asian Pacific shares outside Japan gained 1%, were set for their biggest one-day percentage rise in 4 weeks. Futures indicated that the relief rally might continue in Europe, where the Euro Stoxx 50 features up 0.7%, German DAX features up 0.19%, FTSE features up 0.12% in the rest of Asia. Japan's Nikkei was 0.34% lower, while Australia's S&P/ASX 200 rose 0.56%. Hong Kong Hang Seng Index surged 2.7%. The Chinese markets were closed for a holiday and on a break to next week. Fiscal concerns and worries over a prolonged period of elevated interest rates sent government's bond tumbling in the third quarter, and some investors believe more weakness is in store. U.S. and German government bonds yields are set to end September with their biggest quarterly loss in a year, disappointing fund managers who were hoping for relief from historic losses bonds suffered in 2022 when the U.S. Federal Reserve and other central banks raised interest rates to contain surging inflation. Although analysts see a rise, according to the Bank of America Global Research, Treasuries are on track to post their third straight annual loss, an event without precedent in U.S. history. The jump in yields is hurting equities, which are set for their first quarterly drop this year in U.S. and Europe. Unseasonable warm autumn weather from the United States to Europe is denting sales of heavy sweaters and coats as the critical holiday shopping period approaches, as some stores are already slashing prices to avoid piles of unsold inventories. This is according to executives at major retailers who are already offering a 20% off sale online and in-store for knitwears and outerwear clothing, including merino wool sweaters and long puffer coats. In the past year, clothing retailers have sought to clear excess stocks that had piled up due to shifting consumer demand to essentials from discretionary items like clothing. But with fourth quarter temperatures expected to start off warm, according to weather tracking firms, Weather Trend International, stores carrying winter styles and gear could find themselves loaded with inventories at the end of the season. Crude oil prices slipped today, but we're headed for a gain of 2% for the week, driven by tight U.S. supplies and expectations of strong fuel demand in China. During the Golden Week holiday, U.S. West Texas Intermediate crude fell to sell at $91.65 with a price decline of 0.07%. Brent also experienced a downward price review of 0.31% to sell at $95.08. Bonny Light recorded a downward price margin of 0.79% to sell at $97.63. And for the OPEC basket, crude dealers are offering $95.31 with a price decline of 0.44%.